Corporate finance practice problem using OneNote. Rights offering and the impact on the earnings per share and price earnings ratio. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab, then down in the 1726 Rights Offering, Earnings Per Share, EPS, and Price Earnings Ratio tab. Also note, when using OneNote, look at the Immersive Reader tool. Our practice problems will be down here in the text area as well. Same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon. Information up top. We're going to go through the calculation on down below. Another problem related to the rights offering. However, this time we're focusing in on the impact of the earnings per share and the price earnings ratio of the rights offering. If you want a basic overview of the rights offering, take a look at some of our prior practice problems where we go into that in more detail. The basic idea: corporation needs capital, needs money. How do they get it? They want to issue stocks in order to get it. Stocks are already outstanding. Therefore, they might want to give the existing stockholders some kind of discounted price, which they may be able to do in the form of a rights offering situation. Now, note that we've seen in the past that we would expect that the actual market value of each share of stock would go down after a rights offering, given the fact that the corporation is going to be taking in cash, but it's going to be taking in less cash than the market value, current market value of the stock. So more stocks going out there, but it's not going out there at the market price. So therefore, you would think then there would be a decrease in a dilution in the value of each individual stock. Now, each individual stockholder, we took a look at what could happen to you as a stockholder with that, because then you have the option of basically exercising the option or possibly selling the option. Now we want to look at the earnings kind of situations, the earnings per share calculation, which is comparing to a performance number like the income statement, and the price earnings ratio. So we're going to imagine here we have the shares outstanding, 4 million shares outstanding. Market price rights on is going to be the 50. So rights on, kind of like the market price before the rights offering in essence. Then the net income, we're assuming net income for the company, the performance measure, 13 million. So then they're going to have a rights offering, and we assume that the shares that are going to be sold are going to be the 571,429 at the discounted price of the $44 in the rights offering. So the 44 instead of the 50. Once again, the fact that they're selling these at the discounted price means the assets, if you think about the accounting equation, the assets are going to go up, but they're not going to be going up for equivalent to the market value of the shares. So then you would think that the market price, kind of like the equity side of things, in essence, would not be, you're going to have a decrease in the price possibly due to them issuing the stocks at a lower value there. So the rights needed for one new share, we're going to say it takes 7 rights along with the $44 to buy the one new share. So what's going to be the earnings per share? Let's calculate the earnings per share before this whole thing took place, before the rights offering. We have the net income of the 13 million. We have the shares outstanding of the 4 million. So we're going to take the 13 million divided by the 4 million. That then is going to give us the 3.25. So once again, 13 million divided by 4 million, 3.25 earnings per share before. Then the price to the earnings ratio, which is simply going to be the price, which was $50 before, and the earnings per share at the 3.25, the 50 divided by 3.25, 50 divided by 3.25 gives us 15.38. Okay, so what happens after this is going to take place? Let's first calculate the rights value, the value of a right in the cum rights period, which would be the stock price minus the rights subscription price per share divided by the number of rights required to buy one share plus 1. So we'll calculate that here. We're going to say the market price is 50. The subscription price, the discounted price, would be the 44, the difference being 6. 50 minus 44, 6. The rights needed for one share, there's going to be 7 rights that are going to be needed along with the discounted amount of the $44 in order to take advantage of that discounted price, plus 1 in accordance with our formula. That will then bring us to 8. So we have the 6 divided by 8. that's going to be the 0.75. That's going to be our value of one right, one of the rights. So then let's calculate the theoretical X rights price. This is the TERP. This is kind of another way that we can basically get to this value of one right. Notice this value of one right, we kind of thought of it, as if, isolating down on the one right and the difference in the share. Let's now think about it in for the total here. You can think about the total and see a similar kind of calculation. So the market price of the right is 1. So we're going to say that's going to be the original market price. If you multiply that times the 4 million shares that were out there, that's going to be the 200 million. So we got 200 million at the starting point. Now the new shares that are going to be issued are $44. $44 for the new shares. We're going to say that we're going to issue 571,429 of them. $44 times the new shares that we expect to sell is going to be 25,142,857. This is going to be cash that's going to go into the company, increasing the value of the company, but the cash is less than what the prior market value of the stock was, because it was sold, they were sold at 44. So we can see what's going to happen here. The shares are going to go up from 4 million to 4 million plus the 571,429. And the equivalent value is not going to be the 50 where it was before, but the 44. So if we add this up, then we're going to say the total value of the company now is we would imagine to be the 200 million plus the 142,857, giving us the 225,142,857 for the total value. So it went up because, of course, the cash went up. That makes sense. But now, if we compare that to the total number of shares that are outstanding, before we had 4 million shares, now we add another 571,429 to it. So now we have 4,571,429 shares. So if we divide this out, then we've got the 49.25. So the same idea as we had up top, being the 49.25. If you take the 50 minus the 49.25, the difference we're saying is equivalent in this case to the value of the right. So the 0.75 on the right is the difference between the 50 and the 49. So you can see why that would kind of happen if you take a look at this theoretical X right price type of calculation. So now let's take a look at the X rights price. So we're going to say the market price was the $50. So we got the $50, and then the value of one right was 75. So there's the difference. So the 50 minus the 0.75, that gives us the 49.25 calculation here. So now let's take a look at our earnings per share after this whole thing happened. So and note, when we look at these items, we're kind of looking at like the balance sheet and market value type of things. Like we're saying, where does the market, say we're going to stand after this takes place with regards to the value of the stock. But here we're kind of comparing specifically to income statement like performance type numbers now. So we got the net income, and if we take the number of shares, which is now increased, as we saw up top, it was 4 million. Now we added another 571,429 for 4,571,429. 13 million divided by that number gives us the 2.84. That 2.84 is, of course, lower than what we had before, which was 3.25. Now that makes perfect sense because it has to go down because the net income didn't change. The performance of the company didn't change. What did change is there's more shares out there. And if there's more shares out there, that's going to mean the earnings per share goes down. Although the earnings per share goes down and there's more shares out there, then you have to take into consideration, if you're an owner, did you take advantage of the offering so that you could pick up the extra shares so you would have kind of like an equivalent value in the company that you had before, right? So you got to take those two things kind of into consideration. But clearly the fact that there's more shares out there means that the earnings per share would be less. The original stockholders now had the option of purchasing another share at the discounted price and could have done so, increasing the number of shares that they had. But when you look at the single share, then the price would then be going down. If you look at the price earnings ratio, now we've got the X rights price at the 49.25 compared to the 2.84 on the earnings per share, that's going to give us the 17.32. And if we compare the 17.32 to what we had before, we had the 15.38. So 15.38, we can see both the numerator and the denominator went down, but you would kind of expect it to be the case. In this case, the numerator went to the 49.25 and the denominator decreased to 2.84. So that means we got a higher number with regards to the price earnings ratio than we had in the before this took place.